think 2015 was a good year for the insurance industry. It's been a solid performance. Long-term insurers didn't really get any real investment boost from the investment markets, but the operational earnings were strong. The earnings from existing business on the books came through in the current year. That was quite well. New business, not as strong as in the past, heavily impacted by the increase in yield curves. So the value of new business basically flat on last year, but the margin in that business slightly depressed compared to previous years. There's pressure in the economy. The customer is under pressure. Disposable income is definitely under pressure. The prime rate has gone up. So do you keep an insurance policy or do you pay your rent? So insurers have to really work hard to make sure that they keep their customers on the books, and the competition is strong. So I think in terms of investment returns, for example, is depressed. If you look at the last 3 years, the returns that has been generated is far less than in the past. So you need to go to the market and think about what products do you want to take to market. Do you want to actually give, for example, guaranteed investments? That could be seen as being risky in the current environment with depressed investment, but that might actually be a way to capture market, because as an individual, I know I'm not getting the returns on my investments, but if an insurer is willing to guarantee some of that return, I might be willing to buy that product. So it's risk and reward. So it's getting into different products, but also expanding into different market sets and really look at different ways to do business, focusing on the customer. Well, exactly that. So if insurers, so in the past, in the last couple of years, you've seen insurers migrate to less capital intensive products. But if you do that, it's far more simple products, and then the returns aren't there. So if you want to give that guarantee, you need to have your wits about in terms of your strategy. What's your investment horizon? Look for those alternative investment strategies. Maybe look at alternative energy projects that will give you a nice return over the next 10, 20 years, but that will come with a regulatory cost, because as a regulator, if an insurer is heavily invested in, say, alternative energy, it's not a very liquid investment, so it comes with a capital cost. So, and the insurers, and I think with going into the new regulatory regime like SAM, which is a far more risk-based regulatory regime, insurers also have better information available. What is the true cost of having to write a product, so they can actually do proper risk and risk-adjusted return analyses to see whether it's worthwhile to sell that product or not. So rising interest rates, I guess it's twofold. In terms of immediate, it's negative on the, for example, embedded value and embedded value earnings, because you're present valuing your future cash flows, your future profits with higher rates. In terms of being able to provide guarantees, if there are bonds in the market that are issued at these higher rates, they can invest in those and then actually easier provide a guarantee, because they know that they'll have money at a higher return. So it's give and take, but in terms of their own business, it again places inflation pressure in their own business, and it affects disposable income of your customers. So it's all coming together and making the most of that. I think it affects both. In the short-term space, it's more immediate. So if the rand goes up, it affects your claim costs, because I need to import parts, but I can reprice my product next year if that is a new sustained level. So it's a more volatile result, but you can react sooner and you get over that. In the long-term insurance space, it is far more a long-term game. So if you don't get it right, it will bite you. The important bit is to get your valuation assumptions right. So again, if you got something wrong, it will affect the current year results, because you need to value that and set an assumption for that. But you've got a longer term over which things will, because you wrote a product 10 years ago, you need to provide the benefit, let's say, in the next 10 years. So it's a more longer term game. Regulation has really significantly affected insurers. If you just think about what's on the cards, you've got the new regulatory regime, SAM, which requires far more strict and well-documented governance structures, control functions, etc., and it's a risk-based function. But you've got things like treating customers fairly, which will really say, are you acting in the best interest of your customer, yet you also need to report to the board in terms of are we making the necessary profits that we expect on that? So you now need to look at products and the way you do business far more holistically. And I think it's here to stay. It's not something that's going to go away. So those insurers that are able to embrace this and make it business as usual and get beyond it to actually focus on the opportunities, those are the ones that will come out tops at the end of the day. So I guess globally that you've got Solvency II in a lot of the European industries, European countries. So they are going through very similar process as we are on SAM, TCF, RDR has been a big thing in the UK as well. So a lot of what we're seeing here has now spread over from the globe. It does make life interesting in terms of, if I have to do Solvency II, let's say in Switzerland, but you want to invest in an African country which is not on a solvency basis, you need to get solvent. It could be difficult in the sense that if that gets significant, they would have to get that onto a Solvency II equivalent, but that may make their sub in that country non-competitive because they've got so much more that hoops to jump through compared to, let's say, just a local player that just have to comply with local regulation. Demographics it's important for both your long-term and your short-term insurers. Changing demographics creates different opportunities for short-term insurers. So, understanding where growth is going to be, what are important for your customers, will tell you what you can insure in that space. For the long-term insurers, it's a longer-term game. So, if you think we've got an aging population in that market, you would want to say, how can we actually start selling savings products, pension products for annuities, let's say, and when people get to retirement, compared to maybe a young upcoming population that are starting to buy assets, like this, I'm going to buy a car, then you maybe want to sell some, credit life insurance, etc. So you need to understand what those demographics are in what you want to sell and what the impact of that would be in the next 10, 20 years, so that you are well positioned to reap the benefits of those changes. I think they are. I guess it depends on the different insurers. It depends on what market segment they're targeting. You can see an insurer like Old Mutual with their mass foundation cluster has done really well in the last couple of years, getting that emerging market and selling into that. They've got the brand there and they're doing really well, but it's really which market segment you are targeting and have you got the scale to really benefit from that. I think fintech, if you just think about how you and I interact with our mobile devices, a lot of people have got 2, 3, 4 devices. So the way that those companies are able to see how they interact, I think there's a big opportunity. It's also a threat if you do not come to the party and actually realize what that could do to your traditional model. That could be an issue. But I guess you need to choose your business model. It may be that a traditional insurer decide to rather go for a very efficient back office provider, but partner with a fintech company to really sell and identify the opportunity to sell, but you just actually do the back office, the regulatory stuff. So it's really, it's important to get to the right mix for what you want to do.